Okay, so following up what Matthew just said, clearly the inflation risks, which were one-sided for a couple of years, are now more two-sided. We'll talk about that. The risk to consumer prices have become much less predictable than they have been in recent quarters. After a big move from 9% inflation to 3% inflation, we're now seeing some troubling inflationary concerns that are on the rise. It comes at a time that high public debt, growing economic divergences, and sluggish productivity growth are really limiting policymakers' choices. And this is going to impact policy settings, capital flows, exchange rates, and global financial conditions overall. And last week, we talked about the Global Economic Uncertainty Index spiking up. I didn't put that in the presentation this week, but it clearly is something that is becoming a bigger issue. Augustin Carstens is the general manager of the Bank of International Settlements, which is the central banker's bank. And the other day he came out with this quote about inflation risk being more two-sided than previously thought. I think the bigger issue is the second part of what he's saying here is that the general public has been much more resentful of a short period of high inflation than they were of appreciative of a prolonged period of modestly below target inflation. And I think this speaks to the challenge for policymakers, given that the demands from the public are high, the fiscal space to meet those demands is low. You're doing it as the global economy is going through some major shifts, both from a monetary and fiscal policy perspective, from an economic perspective, from a social and societal perspective. You have geopolitical and political changes going on. At the same time, you have massive climate change occurring, and you need to transition the educational system to keep up with the world we live in today. So there's a lot on policymakers' plates and not enough money to do it. And having a rising period of inflation at this point in the economic cycle is going to be quite challenging. So globally, you can see that the global inflation rate spiked up in 23. You see it come down pretty dramatically on global CPI, but it's leveled off and is starting to even spike up a little bit right now. And that creates some challenges for policymakers around the world. But more importantly, it's well above the 2% target. We'll leave aside whether arguing about 2% is the right number or not. It is what the central bankers are using, and to move off that would send some signals that I don't think they're prepared to send in an environment where global growth is slowing. The US is particularly strong, and there are other challenges around. So last week, we made the case for the Fed pause. Chair Powell is speaking to the Congress today, and basically his comments, which I'll read quickly, are basically he doesn't think we need to move off the stance we're at right now. Give me one sec from his testimony. The labor market's not a source of inflation, which we covered here. We're at 4%. Even with some of the layoffs and all that, we will see a tight labor market going forward. That is going to be an issue, as you can see, higher wages coming through. Mortgage rates have been very stubborn, so they're not coming down, hovering around 7%. We have a problem in the US that you can't port mortgages like you can in other countries. So if you have a low 2% or 3% mortgage rate, you're slower to sell your house. That's weighed on things. But inflation has remained somewhat elevated. PCE came out at 2.9% on last month. But you have policy uncertainty every day hitting us. And I think one of the challenges is, what is the aim of the tariffs and what's the Trump administration trying to do with that? And I think it's important to keep in mind the three goals that they have. The first goal is to support domestic manufacturing, which got carved out when China really took off and we started outsourcing all our manufacturing. The second thing is he is using it as a tool for diplomatic power while the US has it. But the third thing is to raise revenues for the tax cuts he's trying to get through, because just to extend the tax cuts from where they are is a $4 trillion bogey. So those are the rationales for what he's trying to accomplish with tariffs. Whether that's the appropriate use, we could argue all day, but that is what's going on. And I just wanted to set that up because I don't expect rate cuts from the Fed coming anytime soon. There's a growing call for them to come in March or May, but I think it's more likely a second half issue.
Stephen, can I ask a basic question that seems to be debated much more than expected? Do tariffs raise money for the government? Who pays those tariffs? There's there's some debate on that. It seems kind of silly, but can I get your perspective on that?
They will raise modest amounts, not enough to cover the tax issues that he's trying to get, even if everything worked really well, because you have what goes out the other side too. So you are offsetting some growth and revenues with the tariff revenues. So I'm not sure that that math really works. And the second part of your question is the consumer will ultimately pay. Companies will pay first by reducing their profits, but then they'll only go so far before they pass it on to the consumer. So the consumer will pay. What happened on Friday is a warning sign for the markets and for the administration, because when you had the University of Michigan survey come out, go blue. When you had that survey come out, you actually saw
Go blue.
that you were looking at a 1% spike in inflation, and the markets pulled back 100 basis points almost instantaneously. Tariffs are growing in importance on earnings calls, to your point, Pete, because they have to figure out, do they pass on, what can they eat and what do they pass on to the consumer? But look at the mentions of tariffs on conference calls over the last 3 quarters, and you can just get a sense of the perspective and what this means for businesses and how dramatic the change is. So let's go to the next slide here. Oops, excuse me. So I want to just look at inflation in different areas around the world. So you had the tariffs. This is a survey done by Bank of America asking the street what their views are on currency and rates and what are the key themes that they're looking at. And look at the global inflation receleration change from December to now was a huge spike up. And probably the biggest change other than global growth reacceleration, which is basically slowing global growth, is the view from December to January. And those two things are really what's setting the stage for the challenge for investors and for policymakers today. But you can say it's a problem everywhere. These are the US numbers. We're struggling to get to the last percent down to get to 2%. I think the numbers that we report in the next will be a little bit upward in the high 2 range, maybe pressing into the 3% range. That'll unnerve some people. But I think the other thing you have to keep in mind is tariff effects typically are a one-time thing. You raise the tariffs, unless you keep raising them, you get a 10% tariff increase, it's put into the price, and then it's in the price forever. So cost of living goes up. That creates a problem for policymakers, but the businesses will adjust and the consumers will adjust their buying habits. Euro area has the same problem, services inflation leveling off, but their inflation rate is starting to move up, and core inflation is a little stickier, but not to target. The UK, the same thing, wage inflation on the rise, total inflation on the move up, services flattening a bit, but still at an elevated level. And then you go to Japan, elevated again in terms of where they're moving up, but well above target, about 3%. So we have inflationary pressures rising at a time that most of the central banks would like to be lowering rates to stimulate more growth and try and generate a better economic outcome. At the same time, you have these inflationary pressures coming. So one of the market issues is what's the face of inflation? The second one is, with all the spending going on from the hyperscalers and in tech, will that spending drive the productivity improvements that everyone expects and we need, or will it not get the returns? And this is a look at the Amazon, Alphabet, Meta, and Microsoft, and look at these increases. And just to put this in perspective, these 4 are going to see their planned CapEx for next year grow to $320 billion versus $230 billion last year for the 4 of them. So big number changes here in terms of values. There is a broadening out going on, and more of the 493 companies that are in the S&P beyond the Magnificent Seven are starting to increase their spend. So as this goes up and the others increase their spend, you should see higher productivity. But the big question for Wall Street is, will these returns meet expectations from these big companies? And I think that's really what we're looking at right now. To put it in perspective, the Magnificent Seven in Q4 of last year saw a profit growth of about 57%. This year, their profit growth is down less than 30, but they're continuing to spend because they believe it's required. The earnings for the 493 of the S&P, not the Magnificent Seven, jumped about 8% in that same quarter versus Q4 last year, and we think they're going to rise to about 12 or 13%, well above estimates. So you will see a broadening out. The question is, of the 493, how many participate? So do you get a more limited group of the 493? Do you get a full broadening out? I suspect you'll have big haves and have-nots in that 493, and that it will be some part of the next 90 that become participants, not the next 493. So the big issue where we stand today is, does the productivity come through? And we are starting to see it move up a bit. It is limiting labor cost overall, but it has the potential to improve wages. And that's an important concept, so that you can see the wage rate go up, but the wage bill to companies go down because you have fewer people doing more, being more productive. And that's really the goal that we're looking to see. Whether we get that outcome depends a lot on where inflation goes overall. But I do think if we manage the tariffs down to okay levels and we don't escalate this into a full-blown trade war with everyone involved, I think you can get to a better growth period, a broadening out of the growth, because more people will be participating in the productivity improvements. We'll be able to do more with less, and that will allow us to move forward. So how we see the world today, and you'll hear more in a couple of minutes from the DeepSeek crowd and the AI crowd, is DeepSeek and the policies of the new administration have changed the calculus for everybody. We're still trying to sort through what it means. I think the US will continue to be a magnet for capital flows, but if we overplay our hand, and we can snatch defeat out of the jaws of victory pretty easily, but in the near term, money will flow into the US for a whole bunch of reasons, yield differential, the strength of the dollar, and the like. But I think there are growing opportunities, and I've been very negative on Europe and China economically for some time, and that's been a correct call. However, there is a subset of opportunities that are growing there, and the market discounts in advance the economic struggles and the rebounds. And I think you're starting to see the DAX, I think, has outperformed the S&P 3 months running. There are a number of companies in each of these areas that will do quite well. I just think you shouldn't run away from the US in this time, because the strengths of the US will be with us for some time. The challenges of the other areas will be with them for some time as well. I think debt and deficits are complicating policy decisions, and the Republican Party has some real tough decisions coming up. I don't believe they'll be able to get the full agenda put through without expanding the deficit considerably, and there Wall Street will have a problem. The bond market vigilantes are pushing up. You've seen that since the Fed cut of 50 basis points in September. We've had a move up in rates that has been considerable. So I think what we have to adjust to is higher for longer yields, which is a theme, Mark, we've been on for an extended time at ARS. But the other change is it's going to be about earnings, not about multiple expansion. And that means you have to sharpen up your pencils for who wins and who loses with these shifts that are going on, both from trade, the dollar strength, and other areas than the tariffs. So Mark, I'm going to stop there and open it up for questions and discussion, and then we'll get to the AI part.
You're not leaving the stage yet, Stephen.
I didn't expect.
Yeah.
Stephen, can I ask about real rates? Is there an argument that even if inflation pushes nominal rates up again, that real rates have seen their upside for now, that their real rates aren't likely to rise much from here?
Definitely an argument for it. That's the two sides of this. I think we just don't know, and I think it goes back to what Matthew Friedman said before we started the call on the challenges for auto suppliers and the like is how long does it last? Because the big question on the inflationary impact of tariffs is time. If this goes for an extended period, a year or so, you'll see very big impact. If it's short-lived, I think less so. So I think those are real elements. I think the growth overall is pretty good, and I think people are discounting that. But we're seeing, the US is seeing, maybe a 3% GDP growth number out of the Atlanta Fed. We're moving at a pretty healthy clip. So I think that is the other side of it. And I think people might be a little too negative. Ed Yardeni would be of the camp that we're off to the races and that this is going to, all this spending that's going on, all the changes that are going on are going to drive a massive productivity boom. And if we get productivity up to 3 or 4%, you're going to see growth through the roof and you won't be worried about inflation. I think that's the argument that's real for that. So two sides of the story.
That's actually part of the mantra of what you do here. You always give us two sides, which is why we keep coming back.
Working on it.
Andrew.
Stephen, you mentioned year-over-year decline in earnings on some of these sort of, leading companies. There's 13 companies that hold over $1 trillion in cash, Apple being the leader of the pack. So a couple of years ago, when the Fed took short rates from 0 straight to 5 in 9 months, that's an instant bonus to earnings. Do you guys, because I know you guys at ARS do a lot of this work, do you guys have any sense of the impact of just the return on cash to earnings? Because that's a one-shot deal. That was year before. I forget which year we're in now. So do you guys have any sense of the impact of just having $1 trillion in cash and going from 0 to 5?
I don't, but I would actually turn it around a little bit. What they did was what the FANG's Magnificent Seven did is what government should have been doing. They issued debt long, and they were, went out. I think Apple went out 50 years on one of their bonds, right? And then they
1.5% bond, and
right.
You're absolutely right.
So now they're sitting on cash earning 4%. So they are the market the perfect way. Governments did the opposite. They didn't invest long. We started spending when rates moved up and are borrowing now at high levels when we should have issued 50-year debt at lower rates and been able to fund the things we're doing now. So I think one of the things that's missing with the Magnificent Seven is actually what that cash does for them in this environment and what it allows them to do. And think about from a quarter to quarter, they could adjust their spend by $10 billion and make up for any revenue shortfall and still be spending $20 billion or $10 billion on future investments.
Yeah, I was looking at your CapEx table. That's what I was thinking is that, well, you have this one shot boost to earnings, but these are CapEx-like companies. They're full of cash.
Yep.
Now they're suddenly have this big CapEx drive. So I was just curious how that balanced out in your view.
I think they're gonna be able to manipulate their earnings off of their CapEx, and the market will appreciate it. If their earnings are slowing, they slow down their CapEx. All anyone has to do is look at what happened to Meta when they did their year of efficiency. When these guys want to make adjustments, if they tell the street that, the street will respond very favorably. So I think they're in a unique position. I think the question is, out of the 493, who else is positioned well enough to benefit? And I think it's a smaller group than people would think. So I think the market will broaden. I don't think it has the broadening that the hope is.
There's only 13 companies with over $1 trillion in cash.
Yep.
Stephen, Anthony Gordon Hawk, could you
Yep.
talk about on the other side, from in general and or specific, what forms of retaliation are actually meaningful as a negotiating tool from Asia, Europe, UK, etc.? And then particularly as it ties into the tech companies where already we've seen the tremors of, for example, France talking about taxing what are they actually taxing as far as those big hyper tech companies go, and what significant effect does that have? And then how does that trickle down where those, I'm going to call them Trump buddies, whisper or openly directly talk in his ear and say, hey, this is not cool because it's impeding or impacting our bottom line?
Yeah, I think I don't know how far everyone goes. That's the unknown. It's how far does Trump go and what response is he going to get back? I think right now the Europe is saying we're going to hold the line, we're going to play it tough, and at the same time they're giving stuff back to the US. I think most countries are doing that. The question is, what's a win? And nobody really knows what Trump has defined as a win. Right.
Yeah.
So you're kind of flying blind on that. And so are these other countries that are trying to negotiate with them. So you just don't know. I think what hurts is when you go after things that we can't replace here, like the rare earths and things that China's doing. I think China has the ability to really put the squeeze on. And if you look at what Trump's talking about with Canada, Greenland, and Ukraine, all his conversations are about resource-rich nations securing resources. So it's those areas, it's the critical resources for technology and for defense and national security that are the biggest vulnerabilities. I think there are other issues, this cross-border thing that Matthew was talking about with cars, some of that's just nonsensical. So we have to figure out the way to manage that. But I think it's really going to come down to just that. How long does he go and how far does he go? Which will determine the response we get back from others. But I think China has the biggest leverage to hit us, quite frankly. I think Mexico and Canada, as smaller countries, but because of the relationship, also can hurt us in ways that we could hurt them back. And that gets to a lose-lose, not a win-win for anybody. So,
Sorry, could I ask a quick
that's the risk.
question to jump in?
Yep.
So it's Mark Higton. What about the USTR, the United States Trade Representative, and his role in the WTO in terms of initiating sanctions and other sorts of things? Why doesn't America look to take this one step further, particularly in terms of kind of the way in which China is utilizing its trade network with partners to avoid sanctions and to actually, you talked about these natural resources. China doesn't have most of these natural resources, right? A lot of these resources are still coming via the way of the Bosphorus, either from Ukraine or Russia, right? And either it's through the Shadow Fleet or it's through parallel and open ports that, so why, China is making 10x or 15x or more on these natural resources because they're buying ores in Africa and they're buying ores in Ukraine, right? And then they are processing them. And then a subsidiary of one whitelist company is then selling those at an upscaled price to a subsidiary of another whitelist company, right? Then they generate the products and they export them. So obviously they're getting this net gain. If they didn't have these resources, they couldn't be generating the kind of profits and the kind of volumes in exports that they do currently, particularly for solar and renewable
Mark,
products.
Mark, is there a question there?
Yeah, why doesn't the United States Trade Representative, the USTR, use the WTO framework?
I think the U.S. believes, as some people in the U.S. believe, that the multilateral institutions created after World War II have outlived their useful life, and their current mandates are not reflective of the way the world operates today.
Do they actually understand how it works, though? Because the only person that settles arbitrage and cross-border disputes in the WTO is the United States Trade Representative. No one else gets to do it.
I know. I'm answering your question. I don't believe that why we didn't go there was your question. I think we don't believe that that would stop China in particular from the things that we have that they're concerned about with China, like intellectual property theft and the others. And they didn't think the 301 sanctions or the other stuff was going to actually work.
We're running out of time here. Adam, no 5-part questions. Quick one.
No, it's a 6-part, Mark.
Excellent.
Oops, you've been muted.
Stephen, you mentioned you said we don't know what Trump defines as a win. Do we understand what exactly is he trying to achieve with all of these sanctions outside of bringing manufacturing into the country and nearshoring?
As I mentioned earlier, I think he has 3 goals. One is return manufacturing because he believes it's a national security issue. I think
Right.
there's an element that he's correct on that. The second is he wants to generate revenues to pay for his tax cuts. And just be blunt about it. And the third is he wants to wield diplomatic power, however that is, restrict our adversaries and help our allies, or certainly help the U.S. Whether he wants to help our allies has become questionable these days.
Okay. Don't make
Yeah, he's not helping our allies. Certainly not.
So,
any last.
Just to support what Stephen was saying for that earlier comment, if you look at, I did work with the government on the drug supply chain. If you look at the materials used to make drugs, 80% of the raw materials come from China. So what Mark was saying about the supply chain issues, the rare earth and stuff, is really critical. There are a lot of people working on that between Riyadh and which we discussed earlier. But Stephen's exactly right on that.
Well, it's not
So-
only
so-
the pharmaceuticals; it's also a lot of your
Of course,
polymer
yeah.
chemicals.
Yeah, I just worked
Absolutely.
on that, but I agree with you.
all the
Battery-
all the stuff that's dirty to produce, they're
Exactly.
dominating in.
I mean, it's really interesting. If you look at GATT, kind of the BRICS stopped trade-related investment mechanisms and multilateral use of trade-related investment mechanisms, which have been very powerful. And, the BRICS at that time also tried to oppose trade-related intellectual property rights. And that's obviously when we started seeing all this, the debate on parallel imports and so forth. And in terms of medicines, I used to see, well, that's a noble thing, right? But now we can see all of these free ports and all of these parallel import systems and the breach of copyright and everything else, how it's actually being utilized by Russia and the BRICS to, for illicit gains on an unfair playing field, right?
So let's do this. We're at 11:33. Usually we would let this go on. It is a good discussion, but I promised, and literally, we talked about I think last week that we would talk about AI. We were hitting it from different angles, like energy cost and what is this DeepSeek. And then I'll be very honest, I didn't have a panel